It's Sunday, the 22nd of October, 2023, and this is the Platinum Channel Horizon List and 200-day moving average list review of last week's performance. So check it out and subscribe. All right, so this is the Sunday review of the Platinum Channel, and so we're going to go through a couple of charts on the Horizon List and the below the 200-day moving average list. But first off, I'm going to touch on the S&P 500, the Dow Jones, and the NASDAQ 100, the NDX. And we're just going to set the ground of where these indexes are in relation to the 200-day moving average. I'm just going to make this simple. 200-day moving average looks at the average of the trend over a 200-day period. So we're going to take a look at the three indexes that most people look at today. So this is the Dow Jones Industrial Average, and this is black line here is the 200 period moving average. So you can see back in right here about November of 22, the Dow Jones broke above the 200 period moving average, and since then has moved higher up until here recently, where it back in September, around the 25th of September, it broke below, it came back, it has retested, and then now it has fallen over the last three trading periods. This is a daily chart. When I look at this break below 200 and the fact that it could not support and go higher, this is a caution sign to me for the Dow. Now, the Dow is only 30 stocks, doesn't represent a whole lot of companies, but it's blue chip companies, so large cap companies mostly. So let's look at the S&P 500 now. Now, this is the S&P 500. It broke through the 200. It toyed with it from October of, well, actually, that is November of 22. Finally broke through, retested in a sense, and then really started taking off in March of 22. And it got to its peak right around, let's see here, August of 23. And since then, it has declined downward now to its 200 period moving average. This is a daily chart of S&P 500. SPX is the symbol. And it closed below the 200-day moving average on Friday. Pretty big down day. We had three big down days. And remember also to take a look at the VIX. The VIX has moved higher and closed above 20, which becomes a bearish sign for the S&P 500. So take that into account. Our indicators have all turned south. The slow stochastic turned south about 3 days ago, or 3 trading days ago. The RSI is below 50. It's a no bueno. And the MACD, which is a slower indicator, is now turning negative. So it'll be interesting what happens on Monday when markets open. Let's look at the NASDAQ 100. This is the NASDAQ 100 NDX. And what you can see here is we had a breakout over back in January of 23 over the 200 period. It came back, it tested it, and then it took off. And this is heavily driven by those Magnificent Seven stocks, where it then peaked out right around July and has declined ever since. And in Friday, we had a pretty big selling day in the NASDAQ 100, and 3 previous days had selling. The volatility in this index is going up and getting into a territory that is more bearish. And I think chances are we're going to see a test of this 200 on the S&P or the NASDAQ 100 right around 13,884 or so, and a break below that. Pretty significant because a lot of these stocks that are in the NASDAQ 100 are also in the S&P 500. They're also in a lot of ETFs as the biggest holdings, and a lot of people who have 401ks hold the S&P 500, and a lot of these NASDAQ 100 stocks are in the S&P 500, and the Magnificent Seven are pretty dominant in the NASDAQ 100 and in the S&P 500. So this is a cautionary element or thing to me when I look at this. You can see the MACD has started to turn south, a longer, slower indicator. The RSI below 50. This is, once again, a no bueno kind of situation. And the slow stochastic has turned over back on October 12th. So we are seeing weakness in these three indexes, and I believe that probably will continue, especially as we enter more of this economic environment where the 10-year Treasury, actually, let's just take a look at the 10-year Treasury. All right, this is the US 10-year Treasury bond. Now, why is this so significant? It is because a lot of lending is attached to 10 years. So they usually look at the 10-year yield and then they attach their spread. So if I'm a mortgage company, I look at the 10-year yield and it's at 4.18. And depending on your credit score and your risk level when it comes to your income, I would then attach a certain amount of percentages to this. So that's why in the headlines, we saw a lot of 30-year mortgages go over the 8% rate. Now, if you have terrible credit, you're probably well over 10 now. When it comes to car lending, you're seeing a starting point on most car loans is 10% as well. And if you have more riskier credit, like really bad credit, you're in probably the 20% range when it comes to interest rates on a car loan. This is a big indicator of a slowing economy. And if you go back to May of this year, 2023, you saw a break above the 200 on the yield. This means, think of it as a teeter-totter. When the yield goes up, the value of the bond goes down, which if you're a 60-40 investor, you are making probably not much money this year because your bond portion is outweighing the growth of your equity portion. And if you truly are diversified between large cap, mid cap, small cap, the small cap is weighing down your equity portion, and you're probably looking at a 0% return year to date, even though the S&P has been up only because of 7 stocks, really. So this is one thing I would look at heavily. And so when looking at markets, we consider this 10-year yield, which closed on Friday at 4.91%. That means everybody's credit card interest rates are going to most likely go up. Mortgage rates have gone up, and many other credit or borrowing lines have also gone up. And think about this from a standpoint of a corporation who refinances their debt every 2 to 3 years. If a corporation brought in X billion dollars of debt in 2020 or 2021, they brought in at very low rates. They're now refinancing that at a very high rate. And so, give you an example. Wall Street Journal's prime rate is over 8.5%. They're refinancing anywhere between 2 to 6 times their original loan rate, which they probably took back in 2020, 2021 when rates were so low. All right, now let's get into the platinum swing trading horizons list and below the 200-day simple moving average list, and look at how we performed last week when these lists are issued on Sunday evening, Monday morning. And so we're going to review what happened last week and give you some ideas of how the Platinum channel has done overall. Now, if you're not familiar with Best of US Investors, this is our website at bestofusinvestors.com, or you can go to bus13.ai. That's bus.13.ai and get to our website. We have some great information. Kerry's introduction. Kerry Greatmeyer is the founder of Best of US Investors. And we have 3 different tiers. We have the premium list, which is $20 a month. We have a 7-day free trial going with that. We have the platinum list, which is what we're reviewing today, the different swing trading lists, along with some different other lists that we have, long-term indicators on Kerry's BUS portfolio series, which is a focus on artificial intelligence. And then we have the Tribe program, which is access to our Discord for $4 a month. All of our different YouTube channel videos, along with some other information as well. A lot of information in this in our what we offer, and so check it out if you're not a member, and if you're a member, thank you for being a part of the tribe. So if you're a member of Best of US Investors and a subscriber to the Platinum channel, you get access to the Horizon stock list. And so today we're going to review some of the trades that were made on the list, and as well as the 200-day moving average list. All right, so this is the first stock we're going to review on the Horizons list. Horizons list is stocks that meet most of Mark's criteria when it comes to the swing trading program. He has a process that it maps out. The Horizon list, it meets most of those requirements, but is missing something somewhere. And so what we're going to look at today is the Patterson UTI Energy Company. He entered the list last Sunday, I believe, at 13.78 was the entry price, and he exited at 13.88. This is a 10-cent move in the stock. What he found was when he, this is back on Friday's close, so this entered the list on Sunday. It popped up, it got to its 50-day moving average, and then basically broke down, which at that point he started taking his profits out of this stock. And because he knew once it hit that 50-period moving average, it was not going to go higher. It actually tested it 1, 2, 3 days in a row. And then on Friday, it closed back below the entry point at 13.78. So he exited at 13.88, made 10 cents on it. This is a paper trade representation. This is not recommendation or advice, so take that into account. So look, this is a quick trade, 10 cents, not too bad. It's not going to, pay the mortgage, unless you put a whole ton of money into it. But it is a quick trade and gives you an example of when you see resistance or a entry point, as he did on Sunday evening because of Friday's close, and then it hit a resistance level at the 50, and he took his profits. So this is O'Reilly Auto Parts. It went on the list on a Monday, actually Sunday the 8th or Monday the 9th. If you had entered this, it went sideways for basically 3 days and then broke over the 50 and made a jump move higher. It hit his resistance levels, and what he saw was then a retreat, and he cashed out at $940.88. So he entered the trade, entered this O'Reilly Auto Parts, entered the list at $914.67, and then it exited. He cashed out this Friday, or actually prior to that, at $940.88. Pretty big win, $26 win. You can't beat that, right? But what you then saw was this stock broke below, the 9, the 20. It then broke down through the 50, and still this is on the Horizons list because it's below that 200-day period moving average. So saw a place where we hit a resistance level. It broke above. It moved higher through the 50, through the 9 and the 20, but then broke down at a resistance level. Probably, if I'm looking at this, probably around $949.40, and he cashed out soon after that at $940.88. So this gives you a look at how these stocks move in their patterns. Let's look at Berkshire. Now, Berkshire entered the list at $348.43, so right around this area. But soon after, it broke down over a basically 1, 2, 3, 4, 5-day period, And he finally just said, that's enough. That's the only, he takes his losses quick, anywhere between 1% and 3% loss. He's just not going to tolerate that. And so when you're trading these kind of stocks, you take into account your process, your different indicators. And when things start to break down and don't work out the way you thought they were, quickly take the loss. And he did that. He exited it went on the list at $348.43, and it exited the list at $340.89. So he took a loss on that, which is okay. You're going to take losses. You're not going to win all the time. But if you think about it, O'Reilly Auto Parts was up 26 bucks on that trade. And in this case, Berkshire was down roughly just over $7 a trade. So they, in a way, offset each other to an extent. And that's why you create a diversified portfolio. You don't put all your eggs in one basket, but you take losses really, really quick. All right, now let's go to the stocks under the 200-day simple moving average list. These are more riskier trades. Sometimes they pay off really big and sometimes they don't. And as you can see this week, because the overall indexes, especially the Dow Jones and the S&P 500, are all trending downward, we're now starting to see a longer or intermediate trend downward in basically the big indexes. And so we're starting to see more riskier portfolios like the stocks under 200 SMA list. You're seeing more red than you are green. And so that is something to take into account when you're looking at these different lists. All right, we're going to start with Merck. And Merck entered the list at $104.01. Now, if you look at this, you could pretty much understand why. It's a break over the 50-period moving average. See here, 200-day moving average is in black. It's below that. This is a higher risk opportunity. Yet we saw a break support or break, or basically a trend over the 9-day and the 20 period, and it showed signs that it could break above 50, so it went on the list. Yet it broke down. It went on the list at $104.01, and it broke down, and he cashed out at $103.71. He exited right down here. So that one big day on Wednesday, he exited and said, no more. We're not taking losses. We're not going to, follow this all the way down. We took him quick, and he's out. That's Merck. Now, this is ASML Holdings. I reviewed this on the midweek, but I'd like to point out, take a look at it again. You can see where this sort of formation, where on the 9th of October, this went on the list that Sunday before at $581.69. He exited at $600.12, a nice size win. You can see there's this gap in here, and we talked about the gaps on Friday's Zoom call, on the Platinum Channel Zoom call that we have every Friday for members. These gaps eventually get filled, and we're seeing that here. We saw a break right around the, it broke. It showed signs that we could see a break higher. He put it on the list. It broke higher, down in, it broke, entered the list here. Sorry, it's early this morning. And it broke above his resistance levels, but failed at its resistance levels, and he exited. So he exited with $18.47 gain, which is epic. But it was over a period of time. That's the cool thing about swing trading, is it's not day trading. You don't have to sit in front of your computer all day. It's one of those things that you can basically put your positions in, set your stops, and then once you see stocks hit their, go to the resistance levels, you can put in limit orders to cash out. A trade could happen in five minutes, and a trade could happen over 28 days. And that's the cool thing about swing trading, is you don't have to sit in front of your computer all day long. Like day trading, you're just nickel and diming it, and you're trading all day, and most people don't have the patience for that. So he ended up doing really well on ASML Holdings on the below the 200-day moving average. Let's take a look at one more. All right, so this is Colgate, and Colgate entered the list at $70.95. And so right around this point here, this is the close of on October 13th, and then it broke higher, and it hit its 50-period moving average here, and it basically cashed off the list at $72.67. Yep, $72.67 here. And so when you see this kind of situation happen here, where stock breaks higher, this is a nice pump up, follows that I believe that's the 9-period moving average. When you see a break higher, in this case, as we see here, it rides the 9-day higher. It hit the 50 and then hit resistance. You put your stops in at right around that 9 and you cash out, and he cashed out at 72.67. Now, Mark is very risk-off investor, very risk-off. And if you're investing in the 200 below 200-day moving average, simple moving average stocks, you're taking more risk. Now, this is one of those things to take into account. And as I've shown here with a handful of these stocks like Merck on the 200-day, you do lose money. And we had some down positions in the 200. And a lot of that is dictated because the bigger indexes are trending south. So when you're investing, or in this case, swing trading, take into account what the overall trend of the market is, of the bigger indexes, and then bring that down, and they'll give you a better indication of how much risk you need to be putting on. And if you're looking at our list, and the watch list is not up because we've had to recreate it because of an interruption in service, and we lost a whole lot of data, but we hope to have it up this week. But the watch list is the least risky list. Horizon is the second least risky list. It has a lot of criteria that is met, but there's a couple missing things, and that's why it doesn't get on the watch list. And the most risky list is the 200 or below 200-day simple moving average list. So if you can see here in the 200-day moving average list, we have a lot of red versus a lot of green. But when markets are trending higher on a more of a macro point of view, you see bigger gains in the 200. It's all risk reward. So you need to take personal responsibility and do your due diligence of where we are in that risk range. And this gives you some guidance, but hopefully the first part of this video where we reviewed the indexes gives you a better look at things from a bigger point of view. What is the overall index trend? What is the macro trend? And then bring it down to your investments into it. Be quick to take your losses. Be quick to take your profits. At the end of the day, this is about hitting base hits over a 9-inning game. Sorry for the baseball analogy, but most people can relate to that, right? So that's our review of the Platinum Channel Horizons list and the below the 200-day simple moving average list. I hope you become a subscriber. If you're not, please check out bestofusinvestors.com or bus13.ai. We have great series of videos. We have 2 Zoom calls on Friday, one with Kerry, who's the founder. That's at 3 Central, and then the Platinum Channel members, where we review the swing trading list along with some just back and forth ideas about markets, and that's at 11:30 Central, and that's for members only as well. So check us out, bus13.ai. That's bus13.ai. Thanks for joining. Hit the like button, subscribe button, and thank you for your support. Live loud.